All right, let's get right into it. Today, we're breaking down Vir Biotechnology's Q2 2025 earnings. And this one is a classic biotech story, folks. You've got some pretty rough-looking current financials crashing right into this huge, promising vision for the future.
So, here's how we're going to tackle this. First, we'll look at the headline numbers that really spook the market. Then, we'll dive into the pipeline to hear management's side of the story. After that, we'll explore that disconnect, the market's view versus the company's. And we'll wrap it all up with our own rating and what we're watching for on the next call.
First up, the headline miss. Because let's be honest, on the surface, when these numbers dropped back on August 6th, they looked, well, pretty challenging.
Let's start with the bottom line. The company reported a loss of 80 cents per share. Now, Wall Street was already expecting a loss, but they were penciling in about 70 cents, so this missed the mark by a solid 10 cents.
But the top line, whoa, that was an even bigger miss. Revenue came in at just $1.2 million. The consensus expectation was for $2.66 million. So they didn't just miss, they missed by a mile. And that's a steep 61% drop from this time last year.
And this chart really just lays it all out, crystal clear. You can see the huge gap between what they actually reported and what the analysts were expecting for both earnings and revenue. It's a stark visual, and it helps you understand right away why the market had that initial negative reaction. So what happens with a miss like that? Well, no real surprise here. The very next day, the stock got hammered, closing down a sharp 14.4%. The story was simple. Vir misses. But that's just one side of the story. Now we need to pivot and look inside the pipeline, because this is where management tried to build a completely different narrative on their earnings call. The CEO, Marion de Becker, came out swinging with this quote right at the top of the call. It was a really deliberate move to immediately shift focus away from those financials. The message was loud and clear. Forget this quarter's numbers, look at the clinical progress we're making. In this number right here, this is management's key counter-argument. Almost $900 million in cash and investments. So yeah, the revenue was tiny, but this is their comeback. This pile of cash gives them a runway all the way into the middle of 2027. That means they have time to work without worrying about raising more money anytime soon.
And this is exactly what that cash is funding. Progress. They highlighted big steps forward across the board. In chronic hepatitis delta, or CHD, that's their big near-term opportunity. All three of their major studies are now enrolling patients around the globe. And in their oncology programs, they're hitting key milestones for all three of their main candidates.
Let's just zoom in on that oncology platform for a second. It's called PRO-XTEN, and this is the long-term big-picture growth story. You've got VIR 5818, which goes after HER2-positive cancers. Then there's VIR 5500 for prostate cancer. And the newest one, VIR 5525, which targets EGFR in cancers like lung cancer, just dosed its very first patient. The goal here is to build a versatile platform that can hit multiple major types of tumors.
So this all sets up the central conflict for Vir right now. It's really a tale of two completely different narratives, the market story versus management story.
On one side, you've got the market, laser-focused on the here and now. They see the revenue miss, the earnings miss, basically zero sales, and they're worried about the risk of future dilution. Fair enough. But on the other side, you have management trying to shout from the rooftops about their pipeline execution, that long cash runway, real progress in hepatitis delta, and the massive potential of their new technology.
And you can actually watch this tug-of-war play out on this timeline. August 6th, the bad numbers come out. August 7th, the stock tanks. But then, check this out. About 3 weeks later, Bank of America steps in, upgrades the stock to a buy with a $14 price target. And just like that, a month after that terrible earnings report, the stock had actually bounced back and was up over 11%.
And that recovery wasn't just the whole market lifting up either. Virgin's 11.6% gain absolutely crushed the broader biotech indexes like XPI and IBB. This is the proof. It shows that the narrative really did shift from the short-term miss to the long-term pipeline story, especially after that key analyst upgrade.
Okay, so that brings us to our final section, the next call. Let's put all these pieces together and figure out our own take on Vir's outlook from here.
So we're back to the core question, right? How do you value a company with almost no revenue, but a pipeline that's promising and, more importantly, fully funded? Let's break down the bull thesis. The bull case really stands on 4 pillars. First,
That cash runway takes the immediate financing risk right off the table. Second, the hepatitis delta program isn't a moonshot. It has a clear, defined path to potentially getting a product on the market. Third, that oncology platform is like a high-value lottery ticket with massive upside. And fourth, the sentiment is clearly shifting. That both the upgrade is a sign that Wall Street is starting to look past Q2.
All of this means VAR is the textbook definition of a catalyst-driven stock. Its value isn't tied to its current profit and loss statement. It's all about what happens next. Clinical trial results, regulatory decisions, that's what's going to move the needle.
So here is our call. For the next quarter, we expect another loss, probably around 75 cents a share, as they keep pouring money into R&D. Over the next year, we expect the stock to be extremely volatile, moving up and down on any little bit of clinical news. And for our rating, we're initiating with market perform. The potential upside here is significant, for sure, but so are the clinical risks, which makes for a pretty balanced risk-reward profile at this point.
Ultimately, the takeaway here comes down to one word: execution. Can management deliver the data from their big programs? If they can, the stock will work. If they can't, then that cash runway is just delaying the inevitable. That's the gap they absolutely have to close.
And as always, a final reminder, this analysis is for informational and educational purposes only. This is not financial advice.